Hello and welcome back to the Geordie Pig Investor channel. Today I'm going to be going through the British American tobacco stock BATS and if it is a buy right now. So this is a stock which has been trending down over the last year, as we're going to see in a minute, and I'm going to go through if I believe it is a buy, a hold or a sell, and go into full analysis on the stock and break down some metrics as well. So let's get into the video. So if you're unsure what British American tobacco is, I'm going to do a quick rundown on it. Then I'm going to go through a few metrics and different valuation methods that I use to value my stocks. And then I'm going to put them all together at the end and actually show you is a buy or a sell right now. So British American Tobacco is a holding company which engages in the manufacture and distribution of tobacco products. The firm is a multi-category consumer goods company that provides tobacco and nicotine products. So not only does it do tobacco and nicotine, but it actually does vapor products as well as tobacco heating products. And the company manages a globally integrated supply chain, and its products are distributed to retail outlets across the entire world. So it is a recognized global company. And a few key metrics of BATS is it is obviously a UK based company. It is in the tobacco industry, again, fairly obvious as we've just gone through that. It does have a market cap of over 52 billion. It was formed back in 1962, so it has been around a long time. Has over 52,000 employees. It has a dividend growth streak, which is an important metric for us, of over 24 years, with a 5-year dividend growth rate of 3.14 and a massive dividend yield of over 10%, which is really nice to see. The 1-year performance chart shows that it is actually down 20% in the past year, which to some people would be a worrying sign. But does this mean it's on discount? Well, that's exactly what we're going to go through today and find out. So you can see it has been on that downward trend. And what we want to know is, should we buy in now and get it at a discounted price? So the first thing I want to go through is the free cash flow and what is FCF. So free cash flow is the money a company has left over after it pays for all of its expenses and its investments it needs to make to keep the company running smoothly. A good example I like to use is, on a personal level, something that you could compare it to is if you were paying your own mortgage, bills, food, setting your emergency fund up, maybe saving for a holiday or a car. Once you've paid out all of these expenses, it will be the money you had left over a month. So think of that for the company. It's the exact same thing. It's whatever money they have left over after they've paid out all of those bills and expenses. So it's really important to know and understand what the free cash flow is of a company, because it's going to have a massive impact on the direction a company will be heading. A reason why it's so important is because if it has a good free cash flow, it's going to show that it's a healthy company and it's got a good potential to actually grow the business, potentially pay dividends out and also reduce debt. If a company has more free cash flow, then they can be more flexible and they can also make moves without having to worry about trying to borrow money from elsewhere. On top of this, if a company has a good free cash flow, then they can reward the shareholders by giving back through dividends or potential share buybacks. Share buybacks usually lead to an increase in value of the remaining shares. So sometimes dividend may not increase as much as shareholders like, but they're doing share buybacks and people don't realize that these can actually have a real positive impact long term, because it's meaning there's less shares available for the company, so that drives the price up. So it is actually a very, very good for the capital growth of the company. Finally, it's just a really healthy sign to see that a company has more money going in versus going out. Common sense really, but yeah, it is really important to see that. And obviously you'd rather have a company or be buying into a company that has good free cash flow rather than being in debt. So let's move on to British American Tobacco's free cash flow. And you can see on the chart, I have got their free cash flow from the last 6 years. The bars that are above the year are indicating the previous year's December reports. So, for example, the 2018 bar is December 2017, 2019 bar is December 2018, etc., etc. And as you can see from the graph, it sort of initially appears maybe they're on a bit of a sideways trend, but if you look closely, you can see over the last 3 years, it has actually increased by 400 million from the end of 2021 to 2022, and then it's increased by a massive further 1.1 billion from the end of 2022 to the end of 2023. So for me, this has shown enough to really solidify that they're not on the decline like many believe, as right now the tobacco industry is getting quite a lot of heat, as people believe it is on the decline, but they're at the highest ever free cash flow that they've ever had, being over £10 billion, and to have increased it by 1.1 billion over the last year is a really promising sign. The next model we're going to go through is something called discounted cash flow valuation. The DCF model is a valuation method of estimating the current value of a company based on projected future cash flows, adjusted for the time value of money. The DCF valuation process calculates the present value of a company forecasted cash flow based on a selected operating model. The DCF valuation is one of two methods that we're going to be using to value a stock. So what I like to use is the DCF model and another model that I'm going to show you in a minute, and then I'll put the two models together and you get an average from these two models, so it's going to be as accurate as possible. We'll then look at it from a different angle, and I've got a third valuation that I'm going to show everyone today, and from there we will get our final evaluation of the British American tobacco stock. Another way to be certain on my values is by having multiple valuations for each method, so I don't just create one valuation with the predicted numbers. Obviously, with it being a predicted / forecasted numbers, we never know if they're going to be correct, so what I like to do is create a best case, an average case, and a worst case scenario. I usually lean towards the worst to average case scenarios, so I can be very certain on adding new capital at a favourable price and I'm not overpaying for that stock. British American Tobacco's discounted cash flow valuation is as follows. So after putting in the numbers, you can see the current price is at 2,340 GBX, which is the equivalent of £23.40. And by using discounted rate of 7.7% and a terminal growth of negative 2.8%, it has come out at a valuation of 3,033 GBX, which would be an upside of nearly £7. The average case scenario for BAT, as you can see, is 5,123 GBX, which was using the numbers of 7.3% discounted rate and a 0% terminal growth. This is actually showing that it's undervalued by 54%. And finally, the best case scenario, using a discounted rate of 7% with a terminal growth of plus 2.8%, shows that BAT is undervalued by a massive 76%. So you can see the difference between the three valuations here. They're quite drastically different, hence why I like to err on the side of caution and stick to more the worst and base case scenarios. The next valuation I'm going to be using is called relative valuation. So what is relative valuation? Well, relative valuation is a method used to value a company by comparing it to other competitors based on certain metrics. The metrics it uses includes a varied range, such as EV to revenue, EV to EBITDA, which is earnings before interest, tax, depreciation and amortization, and PE ratios. This is the second method I like to use when valuing a stock, and by combining this with the DCF valuation, it calculates something called the intrinsic value. So this is something that was already created and has been used for many, many years. So the intrinsic value of a stock has been used by the likes of Warren Buffett, and famously he used to say, price is what you pay, value is what you get. It hits the nail on the head for me, and that is really what I'm about. At the end of the day, it's great to find a company which has got awesome values and has some really strong numbers behind it, but if it's not at a good price, there's no point paying for it because you're just going to end up potentially losing out on a lot of money. Here's an example of what can be used on the relative valuation model, and we're going to move on to see what BAT's relative valuations were. So a reminder, the price, 2,340. You can see the worst case scenario, it came out at 3,719 GBX, which was an undervaluation of 36%. The average case scenario was 4,114, which was undervalued by 43%. And finally, the best case scenario was undervalued by a massive 49%, and it was at 4,638. So you can see again, it's showing from this that it's looking like BAT is very, very undervalued right now. And we're not only going to go through that, but we're then going to combine them and show you what the intrinsic values are. So as I mentioned just before, it's calculated by adding the two together and then dividing by 2 to get that average. So the intrinsic value, worst case scenario, is a combined total of 3,376 GBX, average case of 4,618, and then the best case was 7,224 GBX. So the final valuation I like to use is something called the Wall Street estimates. Now, you've probably heard of these, but if you haven't, the Wall Street estimates are an average estimate of a public company's quarterly earnings and revenue that leads to a valuation of that company. These numbers are forecasted by company-specific analysts who provides research on that particular company and therefore comes up with what they believe is an accurate valuation. So with companies like British American Tobacco, because it's a big company, they're not relying on one person to do this. So it's not just one analyst and he gets to dictate what prices he thinks it may be. There's going to be multiple analysts who are going to be looking at the bigger and mid-cap companies. The Wall Street estimates are also known as earnings estimates or earning expectations by a lot of bigger brokerages. Typically, they use these Wall Street estimates as a gauge before a company is to bring out their earnings report. And since I'm a long-term investor, I'm looking to hold my stocks for over 10 years. I really don't look to sell many stocks very often. So for me, it's really important that when I'm putting in these valuations and metrics and I find a company that's potentially a buy, I need to be as certain as possible because, like I say, I'm not looking to sell it for a long time. So I want to be able to add this company to my portfolio and then actually add to that position when I feel the price is still undervalued, and then I can reap those rewards long term on it. So now, like we've all been waiting for, well, what is the actual Wall Street estimate valuation of British American Tobacco? They also have a best, worst and average case scenario. So their worst case scenario is sitting right around where it is right now at 2,400 GBX. Their average case was just over 3,100 and the best case sitting about 4,600. So what does this tell us about British American Tobacco then? So now I've got all three valuations. I can combine all three together and then we can find out our best, average and worst case scenarios across all three metrics, which to me is going to be the most accurate and reliable information. So a reminder, the price of BATS was 2,340 GBX or £23.40. And the worst case, combine all three, it's looking at being 3,058 GBX, average case at 4,127, and then the best case being at 6,356. If you use the 10% margin of safety on the worst case price, you'd be looking to buy it around about 2,753 GBX, or if you use a 20% margin of safety, you could buy it around about 2,447, which both are obviously above the current price, so that's really good to see. If you went off the average case, you'd actually be looking at buying potentially at 3,700 GBX on a 10% margin of safety, or 3,300 with a 20% margin of safety. And finally, on the best case scenario, you'd be looking at buying a 10% margin of safety at 5,700 GBX, and a 20% margin of safety would be 5,085 GBX, which is obviously massively above where its current price is. As we can see, the price of BATS is actually even using the most pessimistic answer. At 20% margin of safety on the worst case, we would still be at a buy price, which is really good to see. It's totally up to yourselves if you want to use a margin of safety. You don't have to. You could use a 5%, a 10%, a 15%. You might use a 30%. It's totally up to you. But for me, I believe around about that 10 or 20% margin of safety is usually your best bet, and just makes it realistic because we still want to be able to buy stocks. If you just used the worst case scenario every single time and say tried using a 30% margin of safety, you'd never buy any stocks. You'd just be sitting on no stocks and wouldn't be able to get any money in the market, which is not the purpose of this. So you want to have realistic targets with it as well. So when the price is right, you can get into it. But for now, let's move on to the conclusion and see our final thoughts on British American Tobacco stock, ticker BATS. I think it's trading at a really good price right now, and it's clearly highlighted that across the board with the three valuations we've just gotten. Like I just said there, even on the worst case evaluation, it's really shown some promising signs. The BATS dividend growth isn't massive, but it's still ahead of the historic average of inflation. And with a massive 10% yield in the 24 years of dividend growth, I will personally continue to add to my current position at this price. It's also backed up with the fact that the free cash flow has been increasing year on year over the last 3 years, which is a big tick in my books. I hope you've enjoyed the video today. Please let me know of any other stocks you want a full breakdown on. Thanks for watching. This is the Geordie Pig Investor, over and out.